Ladies and gentlemen, never in the history of time, ever before this point in time, have we ever lived in such a difficult, distressful, awful situation where in mere minutes the markets are going to collapse, everyone's going to have all their gold seized, everything's going to fall apart, and life as you know it is just going to terribly suck. Welcome to reality. So that's what we're used to hearing, right? I mean, every day you tune in these idiots and these different talking heads and analysts, and that's the story, and that's the narrative that they're trying to run across us. And I'm here to tell you that, even though there is a lot of concerns in the markets, there's a lot of concerns with these different bubbles that are rising, is that we're not quite there yet. We're not at the top. There's still room to go, and we're going to talk about some of those things today, as we do all the time. And I just wanted to poke fun and hopefully make this a light-heartening video and, help you enjoy your day. So, by the way, I hope you're having a fantastic day, by the way. If you are, go ahead and smash the like button, comment below, subscribe, share this video, do all that. But we're going to talk about the dollar, the threat of the reserve currency status, once again, kind of making its airtime. Ray Dalio's in some trouble, and we're going to share with you some other data points. So, buckle up, strap in, let's get started. Okay, first things first. So Ray Dalio making his rounds. We got two things to cover with him actually, back to back. So this is the biggest year of losses for him. And then he's saying that once again, the U.S. dollar is at threat of being deplatformed and dethroned rather. And this is interesting, and I think this is a really great conversation. Is we're getting there, but we're not close, okay? It's not like China and Russia is just going to swoop in, or the IMF is just going to swoop in with its SDR currency basket and just say, yep, this is the better solution, and the whole planet's going to say yes. Not everyone is in the WTO, World Trade Organization. Not everyone is in the UN, even if those organizations were against the United States dollars and plotting and scheming. And the IMF and the BIS, which is the central bank of all banks, is... there would still be some transition period. It's not going to be like this tomorrow. You wake up and there's no US dollar. But yet that's how the people, when they read a headline like this or they hear somebody talking about it, that's what they think is going to happen. So understand that right now, yes, the United States is printing a ton of US dollars, but guess what? So is everyone else. So is Europe. So is the Bank of Japan. So is literally everywhere else. The IMF is loaning out money like Skittles, okay? Everyone else is doing it. So the whole story of debasing the dollar, yeah, but everyone else is doing it. The only difference is we don't have negative interest rates. Now, they want to take us to negative interest rates, but that's going to come in time. Remember, the Fed Now program isn't going to roll out until estimated 2023 or 2024. So, like I said, we've got time. Remember, and don't get all crazy on yourself, that there's trillions of dollars in debt, in tariffs, in payments, in this and that's floating around at any given day of the week, and that is paid in US dollars. Even if they wanted to swoop in and take that away, you're not going to really be able to do that overnight. Okay, so again, let's just keep that in mind. All right. Now, I will say that some interesting things about Dalio is. What was the actual returns? It was, I think, negative. Where are they at in terms of returns? Let me just check into this real fast. Down 18.6% for the year, and that's the worst that they've ever had. So looking at this chart here, it's the worst I think they've literally ever had since inception, or dang near. So I just thought this is kind of funny. We are the largest hedge fund for a reason, Dalio said. We have never had significant downturn, all positive years, but we knew that this day would come. We missed the pandemic going down, and that is the reality. So, yeah, stock market doesn't always go up, I guess is the big point here. And Bridgewater is cutting employees. He's got ex-co-CEO Elaine Murray sued the company in July over, compensation issues and gender discrimination issues. There is quite a bit of scruffle within his own house about gender inequality and gender gaps and pay gaps and all that, right? But what was I going to look for here? Clients have remained on the roster tout the firm's 10.4% annualized gain since 1991. Yeah, that's crazy. Since 1991, 10% every year. And we've seen Buffett. There it is. We've seen Buffett, recently go through some downturn, and he added gold to his portfolio for the first time, and big changes going on there. He's starting to drop the banks and go with gold, which 2017 he hated gold. It just reminds me of Bitcoin all over again. They hate it until they need it, and then it's like, this gold stuff's not so bad. So anyways, okay, so that kind of sets the stage here for today. More conversation going on around this. I do tend to think that we go inflation first versus deflation. I think there's plenty of more time in the inflationary pot. This tends to coincide with a lot of what dollar milkshake theory talks about. So I guess if you want a thesis or a box to put me in, you can throw me in that one. Everyone loves to do that. So anyways, that's the Bridgewater and Dalio story. He is back in the news for two reasons. So I wanted to start off by sharing this first bit with you. This is all data from the Bank of America Global Fund Managers Survey. They do this every once in a while, I think every quarter. And what do you know? The biggest tail risks that they are looking at is the outcome of the 2020 election and Confufu second wave. Okay, so because the summer didn't nuke it, which yes, that is a thing. Hot temperatures tend to fare better with a virus. You shake it off quicker and your immune system's stronger, blah, blah, blah. We do have the flu season as what it's been branded as, which is hilarious to me because that just sells flu shots at CVS and Walgreens. But we're coming up on the old season. So there will be a second wave. I don't know how bad it will be, but you've had the president, if he re-wins, talk about the fact that he would not lock things down again. You got Biden saying he would. So I guess it just depends on which team you're on, right, at this point. Okay, and so here's another way to look at that is the Confufu 2.0 is definitely taken over, and that's definitely front and center, okay? Whereas U.S. elections is actually third down, looking at it from this perspective, and tech bubble is second, okay? But what's interesting is that overall, they think that we're in a bull market. And that is, in fact, the most crowded trade right now. So let's take a look at this. And the most crowded trade, and this is just a concept come up with, which just means where's everyone's energy, where's everyone's focus, is longing U.S. tech by a long shot. Okay, tech and growth, you can see it here. And then, look at the right. You can see what's everyone longing, what's everyone shorting. And, the U.S. dollar isn't looking good right now. It's going to continue to fall, and then it's going to start its big rally up. I think we still have a huge U.S. dollar rally that's in store for us. We've been actively working to cut off China. That doesn't cut off U.S. dollars. That actually creates a supply and demand issue because we're bringing so much manufacturing home, which I think is a good thing. And that needs time to work itself out. We're making huge changes, if not going to completely leave the WTO. And the United States is starting to work with other countries all on its own without these three-letter organizations that are, mostly laughable, and work with other countries around the world with ventilators and PPE stuff. And yeah, that costs money, okay? That costs money, and all that money comes back to the United States in dollars. So, longer term here, I am bullish dollar, even though right now it's not doing that well, and it's just got to finish out this part of the cycle. And all this adds to it, the amount of money that they're printing, the stimulus, the all of that adds to the balance sheets. All that adds to a weaker U.S. dollar. Okay, here's the piece now. The same survey, fund manager survey, they believe that we're in a bull market still. So whereas in August, they thought that it was more bearish than bullish. Now it's flip-flopped, and they think that it is more bullish. It is continuing to be bullish, which I think is good. I think the stock market's got plenty of room left in it as well. I mean, I'm not talking technically, and I'm not trying to get down into granular. I'm not trying to be your weatherman here. But overall, there's a lot of room to grow. And if you've been following along with the data that I've been sharing in the premium newsletters, is that valuations versus earnings can go pretty far in a direction. There's a lot of historical data. You can check into it yourself that proves this, and it's not going to be too crazy to see 60, 70, 80% markups on this stuff in comparison to where we are now and what we've seen in the past. So yeah, there's room there to go. That will finish off its cycle, and then we'll get that big hit, that big correction. Okay, and last thing I wanted to share with you was, again, from similar research data is by BOA once again, and just showing you again, corporate balance sheets are we've made a big shift here, and this is where I want to end this. Is remember that just because for the last 100 years the fundamental style of research and investing has worked, and we base things off of a certain system, right, and a certain way of doing things, it doesn't mean that's going to last forever. It doesn't mean that's the only way to do it. It does work. It did work. It is still, well, was still working, and there are other ways of doing things that can also work. And I just want to make that clear. Like, that should be pretty obvious, but we tend to get so stuck in our models that it's like when we start to see it break above that, we're like, oh man, it has to correct. It has to. Jay, you don't understand. Fundamentally, technically, this thing is overextended. It has to correct, right? How many times have we heard that argument? Well, also, too, society grows and change happens. Change happens every single day. And so you have to get used to the fact and be able to adapt to the fact that things might not be the same, and we might be going in this whole new direction. Kind of like when we broke away from the Bretton Woods model and we are a debt-backed dollar. Those changes do happen all the time. When we make the jump to digital, expect these changes to happen again as well. So I just wanted to wrap up with this. I will be breaking this down deeper in a video with much more data points. But yeah, so what this is saying in front of you is that it's not based on tangibles anymore. It's based on intangibles. And because that is at its all-time high, of course, most people look at that as what? Big and scary. So we're talking intellectual property, business rights, brand value, public rights, relationships, all those things. And, you know, if we're being honest, those things do and are very, very valuable. And I'm glad it's getting you know, the recognition that it deserves, and it's getting brought into the conversation because, you know, people and IP and all these pieces are a huge part of the equation. Okay, so am I saying that this is a better model than, you know, let's say a more fundamental based than just simply EBITDA and that model? No, actually, I'm a fan of both, looking into both personally. But anyways, that's what I've got for you today. If you like this video, go ahead and smash the thumbs up button, comment below, share, subscribe, all that fun stuff. Thank you so much for tuning in. See ya.